when you look at the Treasury market, when you look at the equity market, and the scenario that you're painting, what are the ramifications going to be?
Well, I mean, first off, a lot of people have been very concerned about the huge increase in federal spending, the big increase in the deficit, and of course, at the same time, while the Federal Reserve is trying to reduce its balance sheet.
Right.
A lot of people have interpreted that with, rising inflation as that it's going to affect the long end of the curve and the long rates are going to rise. If you look at the financing and that the Treasury is doing, and you look at the Fed's balance sheet, the vast majority of all of it is coming in the shorter end of the yield curve, maturities below 10 years. So what I think we're going to see is we're going to see a meaningful and dramatic rise in shorter term rates. That is between 1 or overnight and 10 years. At the longer end of the curve, the supply congestion isn't nearly as bad. And if people come around to my way of thinking, which is that policy is actually moving toward restrictiveness, then the long end of the curve is basically going to say the Fed is going to contain inflation. There's no reason for us to have a dramatic increase in long-term rates, and the yield curve will flatten. And then going into 2019, when I think the curve will actually be flat or possibly even invert before the end of 2019, that would send a recession signal to us. And that's kind of where I'm expecting to go.